So how do we build a trading strategy? Complementary to fundamental analysis is technical analysis. This studies the effect of the market movements. We're going to talk through this form of analysis as it helps to build a trading strategy of our own. Technical analysis is the study of market price and the volume of trades. This form of analysis doesn't take into account the company, the commodity or the market. Instead, this focuses on the historical market data. From this, charts are provided with historical data, enabling us to try and predict a future market direction. Technical analysis is not an exact science, but nevertheless many people use it to trade the financial markets. A technical trader or chartist always works with three key assumptions. Firstly, market price action leads everything else. The markets are very efficient and effective machines, and within just a few minutes of news breaking, investment banks and professional traders are buying and selling accordingly, and the instrument's true new value is very quickly reflected in the price. This makes it very difficult for normal traders to be able to effectively make money just from news flows. Secondly, prices move in trends and tend to follow simple patterns over periods of time. Finally, history often repeats itself, and perhaps the assumption that technical traders should remember above all others is that prices that have been important in the past can potentially become important again. And by important, we mean they have reached levels that have brought about a big turnaround in the price. The first step to learn about technical analysis is to look at candlestick charts. Most new traders will have only ever looked at a line chart when checking the price of an instrument over a specific period of time. A line chart contains two closing prices with a line joining the 2 points. So, select the instrument of interest. In this example, we're looking at BP shares. We can populate the right-hand table to receive the information we require. In this instance, we've selected to view the BP shares for the last 3 months in a candlestick graph format, and the results are being recorded on a daily basis. We're then presented with a graph showing this detail. Now, this kind of chart contains 4 pieces of information for a given time period: the opening price, the closing price, the highest price, and the lowest price. The coloured bars each represent the opening and closing points at a time in the life of our given instrument. A red bar means that the price has gone down since the market opened, and the green bar means that it's gone up higher since the market opened. There are thin lines called wicks at the top and bottom of each of the coloured bars, and these represent the highest and lowest points that the instrument has reached during our chosen time frame. These wicks can give us an insight into important turning points in the price where there's been a rebound and the price has started to recover. The high and low levels would not be seen clearly in a normal line chart because it only plots the opening and closing points. And these high and low levels are potentially important, and we could very easily miss them if not for candlestick charting. Support and resistance is another form of technical analysis. Although support and resistance is one of the simplest forms of technical analysis, it could be argued that it's also one of the most important. A support level is the level to which a share may drop before rising again. So, for example, if a price drops to 420, then rises to 450, then falls back down to 420, then rises again to 450, it's likely that if it drops to 420 again, it could bounce back again. Remember, we are working on the assumption that history tends to repeat itself. A resistance level is the level a share may reach before the price falls. For example, if a price keeps on hitting 480, then falling back down again repeatedly, it's possible if it reaches 480 again that it could fall back down again. So, how do we identify if a price encounter is support or resistance? We have to plot the trend over the duration we specify and identify the previous highs, the previous lows, round numbers. For example, we could plot 500 instead of 523, and any historical data. How do we draw a trend line? A trend line is a sloping line that shows support or resistance. Before, we were just looking at horizontal lines, but we could also have diagonal levels. There are 3 types of trend lines. An uptrend is where there's a succession of higher highs and higher lows, where the share price sits above the trend line. A downtrend is where the succession of lower highs and lower lows and the share price sits below the trend line. Sideways trends are a period of neither higher highs nor lower lows. Remember, prior to trading, always research the instrument of interest, and before expanding any trading investments, ensure additional research for the new investment is carried out. Technical analysis and the tools available in the Research Centre enable us to make more informed decisions about any trade. Join me in the next video where we discuss technical analysis in further detail.